Hello and welcome viewers to another one-to-one mining investment content session. I'm very pleased to be joined today by Emily Hersh, who is the Managing Director at DCDB Group. Emily's going to be giving us a snapshot of the lithium sector today. So thank you, Emily, for joining us, and I'd like to hand over to you to take us through your presentation.
Yeah, no, thank you, Adam. Thank you, folks at One-to-One for inviting me to give a presentation on the lithium industry and the state of things today. I gave this presentation quite a bit of thought because so much has changed so quickly and so much is still uncertain. But at the same time, the variables in the background that we're handling and thinking through haven't changed. And so I'm going to, I guess, ask for people's patience because this is the first time I've given this presentation. But hopefully it will shed some light on what's happening in the lithium industry today, what's going to happen in the lithium industry in the future, and how lithium juniors can position themselves to be part of essentially the EV revolution. Making sense of the lithium market. I wanted to start with COVID and the crisis that has been created due to COVID because I've been invited to participate in and listen to so many various talks and seminars on the world post-COVID. And I think it's, from my standpoint, we aren't at post yet. We haven't understood how this crisis is going to impact not only lives and health, but the way that we as humans interact with each other, interact with the economy, et cetera. But one of the basic tenets to understand about crises in general is that crises don't create or destroy anything new. Instead, they amplify or mute things that already existed. Or especially in the case of the EV and the lithium story, this crisis is either accelerating or decelerating trends that were already happening. So what are the forces at play? Before COVID kind of took over the conversation, these 8 factors were the main forces pushing and pulling the lithium industry. So the kind of cathode chemistry and what kind of lithium product will be demanded. The cathode chemistry is behind the whole lithium hydroxide or lithium carbonate debate. What makes people choose an EV versus an ICE vehicle? EV demand is really driven by cost parity, or how fast costs of EVs can come down, and performance parity. So when are EVs able to perform at the level that the sort of called range anxiety no longer becomes a problem? In the background of everything, there's overall economic health. There's GDP-linked growth and consumer spending trends that can't be ignored and are going to be at the forefront of the first part of this conversation. The lack of capital investment. The biggest problem plaguing the industry, the lithium industry, has been investor sentiment, led by some high-profile failures, uncertainty about pricing, and just uncertainty in general. And we're going to get into that as well. There's been a lot of talk about new lithium extraction technologies, which DLE, direct lithium extraction, is the top of that list. You've got the question of social and environmental license, which is really coming into play in northern Chile. There's questions of water use and the impact of projects on indigenous groups, as well as how companies and how investors are driving investment decisions based on carbon footprint. We've got the deglobalization of supply chains. Before COVID, the US-China trade war and more consciousness about how much of the lithium battery supply chain is concentrated in Asia and in China has been at the forefront of US policy and is only going to get stronger after this. And then we've got government incentives, or what governments are doing by either putting subsidies in place or setting emission standard policies that promote the transition to EVs. So going from the post-COVID world to what we're looking at now, until there's some clarity about how we're going to come out of this crisis, there's really 3 major topics that are going to drive decision-making in the next year to 2 years. The first is a recession, and I cannot put it any more simply. Unemployed people don't buy new cars. People who have financial risk or are financially feeling insecure don't buy new cars. On the other side, we've got supply chain localization. The decision-making of companies to maximize profits and look at margins at the expense of control over a supply chain is shifting. The pendulum between perfect specialization and high margins is swinging towards control over supply chains and more local supply chains. The carbon footprint of projects or the carbon footprint of an industry is also playing into supply chain localizations because local supply chains will be more carbon efficient due to lack of transportation. And then finally, we're looking at government action. If the world is suffering from a recession, if major countries in the world are suffering from recessions, you're going to see government action in the form of spending and other policies to try to counterbalance that. Which brings us to how these things play off each other. Right now, I look at these as sort of one force on one side, which is the economics of it, the collapse of demand, and then the kind of cascading effects of how the collapse of demand, market sentiment, people's sentiment, demand for EVs goes down. Whereas on the other side, supply chain localization is incentivizing production in areas that maybe wouldn't have been as competitive from a cost standpoint in the past. And government action, we've already seen out of Europe and the UK and China, have incentivized purchasing EVs rather than ICE cars. So you've seen the percentage of new vehicles trend more towards electric. So while total spending is down across the board, the percentage of new car purchases that occur are increasingly electric. Now, as time goes on, I think that these other factors come into play. The recession starts to diminish, and we start seeing how projects can position themselves so that the forces that exist can play to the positive, or the forces that exist are promoting these projects. And what that means is that the projects that are going to be on this benefit side are going to implement new extraction technologies as they're economic. They're going to be projects that take into account social environmental license, clean lithium, green lithium. You know, a lot of these are buzzwords, but you're going to see carbon footprint, water use, and projects that take these trends seriously come out ahead of those that don't. So let's get into, I think, the most sticky issue when it comes to talking about investment in the lithium space and what you'll see the CEOs of lithium juniors wringing their hands over is going to be the magical concept of what's the lithium price. So a little bit of Econ 101 is when you talk about supply and demand, price is this magical place where supply meets demand, and it should communicate to the market how much or how little of a given good to produce. But when we look at how price relates to the lithium market, the timing of when decisions have to be made versus when that new supply or demand can either come online or come offline makes the pricing issue more nuanced. So if you're looking at the lithium market as an outsider or as an investor, you're going to look at lithium price trends. You're going to look at the lithium price indexing. You're going to say, wow, that's not a trend that I want to be on. That's not where you want to be as an investor. And furthermore, you've seen that after COVID, the trend line is exacerbated further downwards. So the case to large pools of capital to get into this game, it's understandable why, you know, you're going to get a lot of raised eyebrows or slammed doors. But when you look at the nuance in that lithium pricing, you see that there are different products even within each subcategory. So within the lithium carbonate subcategory, you see that the trend, that downward trend, is led by the China spot price, whereas it hasn't so much impacted the prices that you've seen from Japan and Korea. That difference is even more pronounced in the lithium hydroxide market, where you see prices remain on fairly firm ground, even as the industry as a whole trends down. Now, that means that those who producers of high quality lithium chemicals that are able to sell into these markets, those actually in production haven't taken the hit to their balance sheet the way that you would expect from the previous chart with a downward price. But while their balance sheet may be safe, that doesn't translate into investor sentiment. That doesn't translate into the appetite for bringing online new projects or investing in additional expansions. So let's look at the demand numbers in detail, because I think that this is the biggest and most important piece of uncertainty that's coming out of the crisis. If we're in a recession, what implications does that have for autos across the board? You know, some of these estimates are so low that the most bearish estimate from Wood Mackenzie projects that global EV sales could drop by 43% in 2020. And so what that means is that while the long-term trends of electrification are certainly not going anywhere, from an investor standpoint or from a sentiment standpoint, that puts something on pause. This is acting against the industry. We've already seen it. The shock that in the short term has COVID being responsible for already a 10% drop in lithium supply estimates for 2020. And I expect those numbers to continue to be revised downward. And this is just, you can see in the post-COVID space. Actually, no, hold on. Yeah, you've seen that post-COVID, the trends are not as jarring, but it's worth taking a look at. And so what it means when supply and demand are out of whack or out of sync is that you have a surplus, you've got an oversupply. And this graph just kind of shows the percentage of the market that is in surplus or deficit. So if you agree that the market is in surplus, or you agree that there is an oversupply, the question then becomes, when does this oversupply end? And this brings into play the likelihood of, in the future, there being a spike in lithium prices, because what we're seeing is that the lithium price is really more relevant to those already in production. It's nuanced, it's complicated, and it indicates short-term inventory, but it becomes a very sloppy proxy for how investor sentiment should be looking at this market. And this is where we get to a very kind of, this is the disconnect that everybody in the lithium industry has to address at all times. This graph to the left is from the recent report out of the World Bank showing the mineral intensity of a green energy transition. And you see that lithium is over here as needing to have a roughly 500% increase in production, or 500% increase in supply, yet all of the price trends that we've been looking at have been falling and showing an oversupply. So there is a mismatch in timing, and then the question is, how does this play out? The way that I look at it, one of three things has to be true. One, prices at some point are going to spike, or production costs are going to be falling to the point that that type of increase can be met at current prices, or the demand numbers are wrong. One of these three assumptions has to be existing in, or one of these three outcomes has to happen. And so I'm of the camp that at a certain point, the prices will spike, because I think that the production costs can't fall to supply the EV market with the lithium that it needs at current price points as demonstrated by across the market trends. And I think the demand will arrive, but the current situation has made it more uncertain or pushed that back. Now, I showed this graph to the right from Lux Research to demonstrate that there really is a lot of different scenarios or many paths that the lithium supply road can take. And that depends on decisions that are made today. And it's more important to lithium than other industries because of the fact that the lithium market is small and nascent. And I'll get back to that in a little bit. This is a quote from Anthony Seed, the CEO of Galaxy Lithium, who showed some of those pricing numbers and some of his models in a recent presentation. And he predicts the model will be in surplus through 2025. But that has baked in a number of assumptions. And one of those assumptions is that certain new projects will come online and certain expansions will come online, as well as the lithium intensity of a battery will stay the same. Now, when we talk about other industries that are more developed, we talk about each project or each individual decision is kind of like a drop in a bucket or a drop in an ocean even. But when we go to the lithium market specifically, we're looking more at a drop in a teacup or even a drop in a thimble. So while these models currently predict a surplus through 2025, the model could change, and it could change quickly if one little drop is added or taken away, which is why it's very important to keep in mind the wheel that we started this presentation with and look at how the variables are interacting with each other. So let's get down to money. The biggest problem facing the lithium industry before the collapse in demand was a lack of capital investment. Investors are scared of this industry. And so the question of who is going to invest the tens of billions of dollars needed to get the lithium supply to reach even the lower estimates predicted by people like from the World Bank to Benchmark Mineral Intelligence to Lux Research, who's going to invest the money needed to get that lithium out of the ground and ready to go into a battery? I think that it comes down to two groups. So if lithium prices are not providing the signals needed to get capital into the industry, it then comes down to who has a strategic interest in making this happen. Now, I show this graph to demonstrate that even the biggest lithium companies don't have the kinds of balance sheets to take on the level of capital needed by these projects. So the two obvious candidates are energy companies, oil and gas companies, and automakers. Now, I think that especially in an era where government action is going to be increasingly important, it's critical to ask the question, how does policy impact the decision-making of these car makers or these oil and gas companies? And there's two very clear examples. The automakers in Europe, following essentially the collapse in demand and the recession, asked lawmakers in Europe to essentially waive their fees associated with their emissions. And Europe said no, they're holding strong. So these car makers, whether it's a great business decision today or not, have an interest in getting these lithium projects online. However, car makers they don't bring in-house experience in resource extraction or resource processing. So there's a gap in technical expertise that would make this a little more difficult. On the other hand, we've got your traditional oil and gas players. And while you can make the case that in the short term, it's not in their interest to see vehicle electrification because it would reduce demand for their product, as you see more and more investment groups prioritize or formalize carbon emission limits, you are going to see some of these energy companies face an increasing pressures to reduce the amount of their business that is derived from the fossil fuels industry. And the oil and gas candidates are obvious matches for the lithium industry, given their experience in resource extraction, their experience in processing a natural resource to multiple high-end chemical products, as well as their ability to understand the risk and the cycles inherent in the commodity space. It's not on this graph, but I'm going to add one more players. As governments take more action in the post-COVID world, I think that there could be a role for sovereign wealth funds to look at the lithium industry, especially as it relates to some of their divestment goals from carbon emitting industries, as well as strategic links between some of their investments in electrification or battery technology. And so I think that the obvious candidates for the large investments that have to come into the lithium space are going to come from strategic players. I think it's more likely to be energy companies or potentially OEMs than your BHP and your other large mining companies. I think that this space is going to be more tied to the energy aspect. And some of the sovereign wealth funds might see this as a good opportunity as well. So this kind of demonstrates the stress and the panic, but I think that the factors that I've seen coming together lead to the conclusion that we will see a price spike and a shortage. And that's going to impact the OEMs and the EV makers. I think we're going to see that potentially as early 2022, especially if we don't see additional investment. But again, with all of the pieces up in the air, I think it's not a case of if, but it's a case of when. And so from the standpoint of looking at the timing of this, it's important to keep an eye on how this market is evolving. So just to touch on two of the issues that lithium junior companies especially should be knowledgeable about. There's a constant question about what lithium is best. Is it lithium hydroxide or is it lithium carbonate? Will the batteries of the future demand carbonate or will they demand hydroxide? And unless you are, there is no better battery. It depends on what battery, what conditions you're making the battery to be used in. And so the classic example of this is that Tesla is looking at using a lithium iron phosphate, an LFP cathode for the Chinese market. And one of the reasons that they're doing that is price, but also safety standards. The LFP chemistry is more stable and thus more likely to be able to meet higher safety standards for thermal runaway and preventing essentially battery fires. That could change, that could, and how that trend is going to evolve depends on a number of other things. So I would say for juniors, don't prepare to fight the last war. Every lithium deposit is to some extent or the other unique. And rather than have a strategy from 5 years to 7 years before you're going to enter into production of saying, I'm going to make hydroxide or I'm going to make carbonate, focus on and invest in developing some flow sheet flexibility so that you are demonstrating a project that has not only the ability to make a high-end lithium hydroxide or potential to make carbonate at very low prices, you're clearly developing an understanding of the stages that you pass through and the type of products you can or can't produce. Because as more innovation happens within the battery, the balance between hydroxide or carbonate could shift, or you might see new technologies creating demand for lithium chemicals such as lithium phosphate, lithium sulfate, lithium chloride as precursors for anodes or cathodes of the future. And so I would say to junior companies that are getting into an argument about whether it's hydroxide or whether it's carbonate world, focus rather on getting the most value you can from your specific deposit, which means developing an understanding of flow sheet that is able to be flexible in the face of whatever the next war happens to be. Finally, I wanted to address the new technology question. direct lithium extraction, I think, has been the buzzword for new technology, but there are other technological advances or technological stories happening in the lithium extraction and chemical production space. And so while I think that when looking at new technologies or when considering what impact this is going to have on the lithium market, rather than look project by project, the question is this technology going to shift the cost curve? i.e., can this technology make it possible to produce, to reach these increases in supply without higher prices to incentivize it? And again, I would recommend you reach out to Jade Cove Partners if you're trying to understand what direct lithium extraction means for you and whether or not it's going to shift the dynamics of the market. Because new technologies like direct lithium extraction, they don't mean just one black box of technology. New lithium extraction technologies are like a toolkit. And so depending on what kind of resource characteristics you're starting with, different tools can be used to achieve the desired outcome, which is the highest quality lithium chemical at the lowest possible price. And so understanding that is, again, part of what makes a lithium junior a strong player. Demonstrating an understanding of your flow sheet, demonstrate having used technology in the best ways possible to lower the production costs or unlock the ability to produce higher value products is important, but it does vary on it varies on a project by project basis. The only caveat that I'll give is that when you look at the CapEx of building a new lithium brine project, I think that there is room to look at both sides or find somebody who agrees and disagrees with it on a project by project basis, because the CapEx of building lithium evaporation ponds or the CapEx of building an extraction facility, when the dynamics of a collapse in demand and uncertainty about when it's going to recover does play into that. But I think the technology will definitely has the ability to shift cost curves or change the economics on a project by project basis. Whether it has the potential to shift the cost curve of lithium production in general is something I would debate, not a massive step change, but incremental changes along the way, yes. But I think that there is a case to be made for the other side, and I encourage people to seek it out. Finally, I want to touch on the issues of social and environmental license, because what we're living through is a time of changing dynamics of power. 20, 30, 40 years ago, companies weren't expected to demonstrate to the public where their supplies came from, whether they were adversely impacting local populations. Whereas, you know, today we live in a world where you say the word cobalt and most people will think of illegal mining practices that exploit children, whether or not that's the case for your project. So I think that companies need to pay attention to questions of water use and questions of social license to operate. We're seeing a lot of formalization in the environmental standards space. So we're seeing a lot of formalization in projects assessing sort of cradle to grave life cycle analyses of environmental impacts of carbon emissions of water use. And we're seeing more space given to conversations that take into account the rights or the priorities of indigenous or local communities. And my bottom line on this one is that these are sort of two categories. When it comes to life cycle analysis and when it comes to understanding the carbon footprint and the water use and the other chemical reagent impacts of projects on the environment, those are areas where quantification and measuring make this clearer, make this better. And it's that kind of transparency will be beneficial for not just the industry, but for all of us and our children and grandchildren who have to live on the earth. When it comes to social license, I'm going to tell a little anecdote. I was talking with two fellows with a lithium project somewhere. And they had a pretty high profile conflict with an indigenous group going on. And they told me that I didn't need to worry about it. It was all political and that it was just two guys. And so I asked them, what are the two guys' names? And they looked at me like I was speaking Greek. And I was like, what do you mean? And I was like, no, the two guys that are causing all the problems, what are their names? And the CEO of the company said, I don't know. And I said, maybe that's why they don't like you. Only to say that relationships can't be bought and they can't be outsourced. And social license to operate is not something that you apply for at an office. It means that the ownership of the project needs to take responsibility for their relationships with the leadership and with the people that their project will impact. They are the first stakeholder of each project, and relationships can't be outsourced. So to sum up, there are a lot of roads that the lithium story could follow. There are a lot of ways that all of these variables could come together and the industry could unfold. But I think it's very important to keep in mind that these are the 8 major forces that are pushing and pulling the industry forward. And as we go through this crisis and as we have more information, we'll be able to see the way that this comes together. So I would encourage taking a look before just blindly or before just going with a forecast or picking a forecast. Understand the assumptions that each of the lithium forecasts make about these key areas, and keep in mind how those things are changing, and if they change, what it does to your forecasts. So that is it. Adam, do you have any questions?
Fantastic, Emily. Thanks very much. It's a really good presentation and excellent slides there, and great to get the run through indeed. Yeah, I was taking some notes and just wanted to maybe develop on some of the points that you made.
Absolutely.
One area that I was curious in around, you were giving some reasons as to what perhaps has kept capital away from lithium at the minute, maybe at the moment, or maybe lithium juniors. What's sort of inhibiting new capital flows, whether it's through equity markets, coming into the lithium space at the moment? And I wanted to just get your thoughts. Do you think this is perhaps because, you know, the lithium industry and the process behind mining lithium isn't a straight mining process? You know, investors or even if they're sort of more generalist, might be looking at it as a sort of technical processing company or a chemicals company, as opposed to a straight mining company. So if you're talking to a straight mining investor, lithium kind of sits in a slightly different mindset to perhaps something like precious metals or something or industrials.
Well, I think that, Adam, that's a really good question, and it brings about something that is true, not just about lithium, but about the whole category of technology metals, which is that there are 2 processes that have to happen in parallel for a project to be a success. And one is the mineral extraction and sort of your physical processing. And then your second step is your advanced chemical processing step. And I say that because I can tell somebody doesn't get the lithium industry if they use the word refining. Because the word refining means purification to create a commodity that becomes interchangeable. And when you're working with lithium, you're working with something that inherently and fundamentally is coming out of the ground in a combined form. And then you're doing an advanced chemical process to get the lithium atom to come off of the current chemical combination and into another chemical combination that you can then use to transport that little lithium ion into another chemical combination to get it into the cathode. And so that is, you're right. And who has both of those skill sets? Because chemical companies are uncomfortable with the mining aspect of it. and mining companies are uncomfortable with the advanced chemical processing aspect of it. And that's why I've reached wouldn't call it a conclusion, but the inkling that the oil and gas industry actually does have both of those skill sets in-house, right? If you're an oil and gas company, you do extractive and you do advanced chemicals, you know, a SABIC of the world, right? The SABICs of the world would be ideally placed to put a foot into the lithium industry, Saudi Basic Chemicals, for example. With the automakers, what I see is if the automakers end up being the ones who write the checks to finance the lithium industry, they're going to do it kicking and screaming. In the sense that from a managing their business standpoint, automakers are facing a perfect storm. You know, it's like The Shining, I'd say. Every day you walk into an automaker's office, you know, they're dealing with emission standards, penalties, you know, the car ownership going down, a pandemic, you know, 40% drop in sales in a year. That's devastating. And then on top of that, you know, the OEMs don't have in-house a group of people who build and operate mines. You know, the auto industry has evolved around the fact that the value add that each automaker brings is, you know, it's the chassis, it's the engine, and then they kind of outsource or, you know, each part, right? And so having somebody in-house who's able to, let me put this another way. The point at which I think that the OEMs are actually gung-ho about this, and I'm going to put Tesla aside for this, is when I start seeing friends of mine getting hired from Canadian mining investment banks to go work at Volkswagen. Until we start seeing groups of humans with the experience and the ability to understand investing in mineral assets, I don't think that the OEMs are as serious about it as we wish they were. Or they are poised to make a couple of expensive mistakes. But I think that the OEMs will eventually do it if nobody else does.
Yep. As far as I understand, a lot of the OEMs are putting new rules in place around security of supply of raw materials. I don't know if they're from mining backgrounds specifically, but they're certainly on material supply chain expertise that are looking at that. I know Tesla has a lady who I can't remember the name off the top of my head, and of course they're a standout case. They're a unique company in that respect. But do you see this as something that they're going to be moving on through hook or by crook because of the situation that you described at the minute? It is quite a difficult, very difficult period for auto manufacturers.
Analysis is very different than execution. And execution in a space where there is no copy and paste. You know, you find a gold deposit, you find a copper deposit, you find gold and copper deposits that behave in a similar way. There's a rule book. Lithium doesn't have a rule book. And I could keep going back to flow sheets, because understanding your specific lithium flow sheet and learning how your deposit behaves is something that I would encourage junior CEOs to spend more time on, because that's what's going to make or break that product, because you are going into a market that doesn't exist yet. All of our forecasts are going to be wrong, because that new technology from one thing has ramifications on the other 7 steps and vice versa, right? So I think that the localization and the need to demonstrate, you know, there's 2 risks, right? There's reputation risk from either sourcing environmentally unfriendly or unethical product versus the risk of disruptions. And so those 2 things get lumped together because a lot of the solutions are the same. But I think that you have OEMs evaluating their supply chain in both of those ways. And a cool future panel, I think, would be having somebody who evaluates a supply chain for for risk, like geopolitical risk, like is there going to be an earthquake or is this, versus somebody who evaluates it for environmental and social risk. Like that would be a cool conversation, because the environmental and social risk element of that is a new aspect to evaluating supply chains. Evaluating supply chains has existed, I assume for quite a while, but the addition of environmental and social aspects to that process, I think, is something that companies are still feeling their way around for.
Yeah, and that leads me to one last point. Actually, I wanted to raise around ESG mandates. It's obviously a driving force behind the asset management and the asset owner industry. Mining, from what I did a panel on it a few sessions ago that we also recorded, and actually it's quite clear that mining is very good in some respects, actually, depending on the company, of course, but mining's been so much in the spotlight as an extractive industry that a lot of companies get certain elements very right. And now the focus at the moment is very much on the environmental area. Not to say the other elements of the S energy have dropped, but environmental is very much the spotlight. If we think about decarbonizing government agendas, what's been narrative globally for the last few years. So how does that translate to the lithium juniors that you work with now, or how do you see the lithium companies adhering to that, and can they move more into this ESG mandated funds sort of crosshairs, if you like, with better reporting standards?
Yeah, I mean, so there's a couple of things, and I'm going to take your question on kind of three levels. One is sort of the high end, disconnect or cognitive dissonance between human beings, especially, fancy little millennials like me, and our relationship with things that come out of the earth. This is my coffee pot. If I don't look at this every day and be like, this came from minerals, am I an idiot? I should be, right? This came from minerals. This was a quarried, processed activity. And I think that on that level, there's all these articles and talk about like the dirty secret of the renewable industry. And you're like, how is this a secret? It's a freaking giant, look at a wind turbine. And if you think they're trying to keep it a secret that it came from a mine, like your bar for secrecy is very low. Please don't go into an international spy agency, right? Like that is not the field for you.
Do some research.
So do some research. And I think that then that kind of goes to the second level, which is what are companies supposed to do about it? I consider myself an environmentally sound and savvy person, and I work in the mining industry, and I don't see a disconnect between that because, mining practices, when good, I'm not gonna say best because, best practices is a misnomer. That'd be one practice, right? But good mining practices, responsible mining practices, mining can be done in such a way to minimize negative effects. Mining can be done in such a way to, let some of the benefits of the mining operation spill over into the communities where it is. And I think that the thing that people don't want to talk about, right? My consumer friends, I'll put it, my millennial friends, this came from a mine. If I pay more money for this, it's more likely that the company that sourced it was able to buy that product from a responsible mining operation. Environmentally responsible mining practices are more expensive. So does that mean that investors are going to lose margins because somebody has to pay more? Does that mean that consumers need to pay more or consume less? That's the problem with the consumerist, to get philosophical with you, the problem with the kind of consumerist mindset that capitalism in its current iteration has is that my idiot friends who hate mining feel social pressure to buy a new iPhone every year. And they don't see that as ridiculous, whereas they see renewable energy having a dirty secret of mining. And so I'm using that kind of like attitude to answer that question, because I think it's important to take problems face on and to get over it with the inconvenient truth that things come from minerals, and understand where your stuff actually comes from, rather than wanting some little stamp to tell you that it's okay. So rather than saying this mining, you know, this lithium is green, so I don't have to think about it where it came from, I think ESG standards should, rather than giving it a green or not stamp, provide more information of the provenance and the process, and help educate people to make their own decisions on it. So I hope that answered your question. It's a tough question because it brings in a lot of areas, but I do think you have to start at this, you know, weird cognitive dissonance. You know, I do a podcast called the Minerals Manhattan Project now, and I did an interview with my producer who does AR and VR. And we had a great conversation about how none of her peers, you know, as they're building these headsets and looking at these headsets, think about the fact that every piece of technology in there started in the ground, and that advanced material processing, you know, if you think it's difficult to make lithium for a battery, imagine making the tiny pieces in all of this type of advanced technology that we're using. So minerals and technology go hand in hand. And I think that ESG practices should provide information rather than a stamp.
Yeah, certainly. I mean, the reporting standards are evolving, and what the LPs are asking the asset managers for in terms of these reporting standards are getting more and more stringent. So, but equally, that's driving better practice or better company management within those standards, as you say. So yeah, I think it's becoming a lot more than just a sort of tick box exercise. But just to summarize on, do you think the mining companies are adjusting to that quite quickly? Or is this something they've always been doing, and actually it's just a message change that's coming out to hark to your first point, really?
Yeah, I think there's cases on both sides. And I think that in terms of doing that, I would encourage investors and consumers to get to know the leadership of companies and make a call for yourself as to whether or not you think that person is rubber stamping it, phoning it in, mailing it in, zooming it in, or if, you know, is green lithium, what does that mean? I think that, so to kind of raise that standard, zero carbon lithium, that is a scientific word, right? If you say this lithium is produced with X carbon footprint, zero carbon footprint, negative carbon footprint, that's a scientific word that you can then find an expert to verify. If somebody says that this is green lithium, then the next question is, what's the carbon footprint? What's the water use? What's the this, right? So green and clean should be able to be backed up with science words. And they shouldn't be backed up with someone saying, well, everybody wants green lithium now. And you're like, that's fantastic, but what's the science words there? And so I think that metric is not one you can judge just by a company's presentation, but it's a very easy distinction to draw with a 5 to 10 minute conversation.